Silver just crossed $79.43. I want you to stop whatever you are doing and focus on that number for a second. Not because $79 is the target, not because $79 is the ceiling, but because of what happened in the 90 minutes immediately before it got there, and what happened in the 12 minutes immediately after. Because if you understand those 102 minutes, you understand everything that is about to happen to this market. And the vast majority of people watching silver right now, even the people who have been positioned in silver for months, do not understand what those 102 minutes mean. Here is what I am going to show you today. I am going to show you a documented pattern in this market that has now appeared 3 times in the past 6 weeks. I am going to show you what the commercial short book is doing right now that is almost never discussed on channels like this. I am going to show you what Shanghai is doing in physical settlement that directly contradicts the COMEX paper price you are watching. I am going to show you the industrial demand number that just came out of the solar sector that changes the supply math entirely. And I am going to show you the specific price levels in the next 48 hours that will tell you definitively whether this move is the real breakout or the setup before a deeper flush. This is a serious analysis for serious investors. Let's go. Silver is trading right now at $79.43 on the bid, $79.61 on the ask. Today's range has been $77.18 on the low and $79.43 on the high. That high is not an accident. That high is the 3rd consecutive test of the same resistance cluster that silver has been building toward over the past 3 weeks. And each test has followed an almost identical pattern. Test 1. Silver spikes to resistance, gets hit with paper selling, drops $3 in 40 minutes, recovers within 48 hours. Test 2. Silver spikes to resistance, gets hit with paper selling, drops $2.80 in 1 hour, recovers within 36 hours. Test 3. Today. Silver spikes to resistance, paper selling appears, and we are sitting $1.20 below the high, watching it hold. You see what is happening? Each rejection is getting shallower. The paper sellers are hitting the same level with the same force, but the physical absorption is getting stronger. The market is eating the paper supply faster each time. That is not a pullback pattern, that is a coiling pattern. And coiling patterns in commodity markets resolve in one direction with extreme violence when they break. Now here is what most of the commentary is missing about this specific moment. Gold right now is sitting at $4,718 on the bid. That gives us a gold to silver ratio of 59.4 to 1. 2 weeks ago, that ratio was 63 to 1. 4 weeks ago, it was 67 to 1. The ratio is compressing. Silver is outperforming gold in the move that has already happened. And that compression is accelerating, not slowing. Historically, when the gold-silver ratio begins a compression move from levels above 60, the move does not stop at 50. It does not stop at 40. In the last 3 major cycles, ratio compression from elevated levels drove silver to a gold-silver ratio below 30 before the cycle exhausted. We are at 59. If the ratio simply returns to its 2011 cycle low, silver at current gold prices would be above $150. That is not a price target I am inventing. That is the mathematical output of historical ratio compression applied to today's gold price. I am not telling you it happens tomorrow. I am telling you the structural math has never been more clearly pointed in this direction than it is right now. Let me take you to something that happened in Shanghai in the last 72 hours that has received almost zero coverage in Western silver media. The Shanghai Futures Exchange physical silver premium over the COMEX paper price reached $11.40 per ounce. $11.40. That means buyers in the physical market in Shanghai were willing to pay $11.40 more per ounce than what the paper price on COMEX was showing. Think about what that gap means. If the COMEX price were the true price of silver, the price at which physical metal was freely available, there would be no premium. Arbitrage would eliminate it. Traders would buy physical at COMEX prices, ship it to Shanghai, and capture the spread. The fact that the premium exists at $11.40 means one thing. The physical metal is not freely available at the COMEX paper price. The people who need physical ounces, not paper contracts, not ETF shares, actual deliverable silver, are paying $11 more than the paper price to get it. That is a physical market pricing silver at roughly $90, while the COMEX paper market prices it at $79. Now let me connect this to COMEX registered inventories, because this is where the math starts to break down in ways that should concern everyone on the short side of this trade. COMEX registered silver, the metal that is actually available for delivery, not just held in licensed warehouses, but specifically available to be delivered against futures contracts, has declined materially from its peak levels. We are watching a market where the open interest, the paper claims outstanding against physical silver, continues to trade at multiples of the deliverable inventory. This is not a new observation. What is new is the rate of change. The ratio of paper claims to registered physical ounces is moving in the wrong direction at an accelerating pace. And each time silver has a delivery month, the mechanics of that delivery put additional strain on a registered inventory that is not being replenished at anywhere near the rate it is being drawn down. The paper market can set the intraday price. It is large enough to do that. It has the liquidity to do that. But it cannot conjure physical metal. And at some point, the gap between what the paper says and what the physical market needs to source becomes too wide to paper over. When that moment arrives, and the documented inventory trajectory says it is building toward exactly that moment, the price adjustment will not be orderly. Here is what I want you to take from this section. Today's price at $79 is a COMEX price. The Shanghai physical market today is pricing silver at approximately $90. The question you should be sitting with is not whether $79 is the right number. The question is, which price is telling the truth about what silver is actually worth to the people who need physical ounces? And the answer to that question has very significant implications for where the COMEX price is ultimately going. I want to give you a number that was released this week that I have not seen covered on a single major silver channel. The International Energy Agency updated its solar photovoltaic installation forecast for 2026 through 2028. The revision was not small. The IEA increased its forecast for annual solar installations by 23% above their previous estimate due to accelerating policy implementation in the EU, accelerating private capital deployment in Southeast Asia, and the continuation of Chinese domestic solar build-out that has not slowed despite diplomatic tensions. What that 23% upward revision in solar installations means in silver terms is this. Modern photovoltaic panels require silver paste in their cell fabrication. The average silver content per panel has been declining as manufacturers optimize, but the rate of decline in silver per panel has been slower than the increase in total panel volume. Net silver demand from solar continues to rise. The IEA's revised forecast implies a solar sector silver demand increase of approximately 28 to 32 million troy ounces annually above prior estimates, 30 million ounces. To put that in context, total global silver mine production last year was approximately 820 million ounces. The solar demand revision alone represents a roughly 3.5 to 4% upward shock to total demand versus available supply. And this is from a single demand category. We have not discussed electric vehicle charging infrastructure. We have not discussed the 5G network expansion in markets where it is still being built out. We have not discussed the defense electronics procurement surge that is running across NATO member countries and in the Indo-Pacific. We have not discussed semiconductor fabrication demand. Each of these is a separate, compounding, structural demand stream. On the supply side, the picture is unambiguous. Primary silver mine production has been essentially flat for 4 years. The capital expenditure to develop new major silver mines was not deployed at scale during the period of lower silver prices. The pipeline of new silver supply entering production over the next 3 to 5 years is not sufficient to meet existing demand projections, let alone projections that have just been revised 23% higher by the world's foremost energy research institution. This is a structural deficit that is getting worse, not better. And it is happening invisibly to most market participants because the paper market's daily price signal does not reflect long-duration physical supply and demand dynamics. The paper market reflects today's positioning. The physical market reflects where the metal actually needs to go. Right now, those two markets are telling very different stories. History is unambiguous about which one wins in the end. I want to walk through the commitment of traders data because the most recent report contains something that deserves serious attention. The COT report, released weekly by the CFTC, breaks down futures positioning by trader category. The category labeled as commercials traditionally includes the large banks that serve as market makers and have historically maintained the largest net short positions in silver. This is documented, publicly available, and has been a consistent structural feature of the silver market for decades. What the most recent COT data shows is that commercial net short positioning is at a level that, historically, has preceded significant price moves in the underlying metal. This is not a novel observation. Multiple serious analysts track this data point precisely because of its historical predictive value. Here is the mechanism. Large commercial entities build short positions during price strength. They use those short positions to manage risk and, in some interpretations, to actively manage the price. When the price moves against those short positions, there is a crossover point where the cost of maintaining the short becomes prohibitive. At that point, covering begins. Covering is buying. Buying pushes the price higher. Higher prices force additional covering. The feedback loop, once initiated, can move the price faster and further than almost anyone expects. The current commercial short position, based on the most recent reporting data, is at a level where the mark-to-market pressure is meaningful. Silver at $79 is not silver at $55. Every $1 move upward in silver with a large concentrated short position translates to tens of millions of dollars in mark-to-market losses for those position holders. The pattern we have seen in the last 3 tests of resistance, and this is the key observation, is that the paper selling has been absorbing rather than breaking. The shorts are hitting the market, the price is retreating, but it is retreating less each time. The physical buyers underneath are getting more aggressive, not less. The battle between paper supply and physical absorption is shifting incrementally each week. This is not a guaranteed outcome. Markets can stay irrational, as the saying goes, longer than you can stay solvent. But the observable data in the COT report, combined with the physical absorption we are seeing at every paper-driven dip, creates a structural picture where the eventual forced covering event looks increasingly inevitable. The question is timing, not direction. Let me tell you exactly what I am watching over the next 48 hours, because that is the specific time frame that matters for near-term positioning. Level 1, $79.43. That is today's high and the third test of near-term resistance. If silver closes above $79.43 in tomorrow's session, it changes the technical picture materially. A confirmed close above 3-test resistance is a technical breakout signal, not a spike and reject. Level 2, $77.18. That is today's low. If silver breaks below today's low with conviction, meaning it breaks below and holds below for more than a session, that shifts the near-term momentum, and the correction likely has more room to run. The zone between $77.18 and $79.43 is the decision range. Right now, silver is holding inside it. The direction it exits this range in the next 48 hours is the signal. If we break higher, the next resistance cluster is in the $82 to $84 zone. The move from $79 to $84 would not be a gradual grind. Based on the momentum characteristics of this market, that kind of breakout tends to happen fast, in days, not weeks. If we break lower, the structural support is in the $73 to $74 zone. That is the prior base that was established before this most recent leg higher. A pullback to that level would be painful in the short term and would represent an extraordinary opportunity to add to physical positions at a discount against the physical market's real price. Either way, the structural thesis does not change. The IEA solar demand revision did not change because of today's price. The Shanghai physical premium did not disappear because of today's price. The COT short positioning did not reset because of today's price. The structural forces building underneath this market are larger and slower moving than any 48-hour price window. But the 48-hour window tells you what the short-term path looks like. And knowing the short-term path helps you make better decisions about timing, position sizing, and whether to be adding or holding at current levels. Here is the summary of what we covered today. Silver at $79.43 is the third test of near-term resistance. Each rejection has been shallower than the last. That is a coiling pattern, not an exhaustion pattern. The gold-silver ratio at 59.4 to 1 confirms silver is outperforming gold, and the structural compression still has an enormous amount of run. Shanghai physical silver is pricing $11.40 above the COMEX paper price. That gap is not arbitrageable because physical metal is not freely available at the paper price. The physical market is telling a different story than the paper market. IEA revised solar installation forecasts upward by 23%. Implying a 30 million ounce demand shock to a supply picture that has no capacity to absorb it. COT commercial short positioning is at a level that historically has preceded significant price moves. The pattern of shallower rejections at resistance suggests the short position is absorbing physical demand rather than breaking it. The next 48 hours will tell us whether we break above $79.43 toward $82 to $84 or pull back toward $73 to $74 structural support. The structural thesis is intact regardless of either outcome. This channel is where we cover this market with the level of seriousness it deserves. Subscribe. The next several weeks are going to generate some of the most important signals this market has produced in years. We will be here to analyze every one of them. Comment below. Tell me where you think silver goes from the $79 level and what you're watching. I read every comment. Stay patient, stay positioned. Talk soon.